Hello, this is part 1 of the Chapter 7 lecture series on bank reconciliations. Let's get started. The use of a bank helps to improve the internal control over cash. It minimizes the amount of cash on hand, and it provides for a double record of bank transactions, one record kept by the bank and one record kept by the company. Therefore, there will be two balances for cash: the bank balance determined by the bank and the book balance determined by the company. The transactions recorded by the bank will be reflected in what's called a bank statement. The company will normally receive a bank statement a few days after the period ends. Typically, bank statements are sent every month. So, for example, we will likely receive the bank statement for the month of October sometime around the 2nd or 3rd of November. The bank statement includes several things. First, it will indicate the beginning balance for the period, which will be the ending balance from the prior period. It will also include all credits or increases to the account. I know this seems strange because we have learned that if cash increases, we must debit it. So why are increases called credits? Well, you have to remember that the bank statement is prepared from the bank's perspective. Cash that it holds for customers is a liability to the bank. This cash belongs to the bank's customers, not the bank. So when a bank's customer makes a deposit, the bank's liabilities are increasing because it now has to hold more money for its customer. We know from Chapter 3 that when a liability increases, we must credit it. Thus, increases in customer balances are called credits. Examples of credits are deposits and credit memoranda. There are two examples of credit memoranda. First, the bank may collect a note receivable for a customer. They will typically collect the principal and interest and deposit this amount less a fee into the customer's account. The second example of a credit memo is interest earned on an account. Some accounts pay customers interest on their account balances. The bank will deposit the interest earned during the period into the customer's account at the end of the period. The bank statement will also include all debits or decreases to the account. Again, I know this seems strange, but it's the same logic as credits. When a bank's customer makes a withdrawal, the bank's liabilities are decreasing because it now has to hold less money for its customer. We know from Chapter 3 that when a liability decreases, we must debit it. Thus, decreases in customer balances are called debits. Examples of debits are checks and debit memoranda. There are two examples of debit memoranda. First, banks often charge their customers service charges each period for servicing their accounts. Banks debit their customers' accounts for these service fees. The second example of a debit memo is an NSF, which stands for Not Sufficient Funds. With an NSF, the bank's customer deposits a check. The bank then credits or increases the customer's account for this amount. The bank then sends the check to the check writer's bank to collect the money. Instead of sending money, the check writer's bank sends back the check stating that its customer didn't have sufficient funds in their account to cover the check. The depositor's bank then debits or reduces the customer's account for the check amount. This seems complicated, but it simply means that the bank's customer deposited a check that ended up being a bad check. So when the deposit is made, the bank increases the customer's account balance, and when the bank discovers the check is bad, it decreases the customer's account balance. The last item indicated on the bank statement is the ending balance for the period. Here is an example of a bank statement for Laird Company. The bank statement covers the month of April. The beginning balance is indicated, then the total credits, then the total debits, and finally the ending balance. You're also provided a listing of the individual credits and individual debits to the account. Finally, you are given the daily balance. Because the bank and the company are keeping track of the same transactions, you may think that the balances will be the same. However, the balances are rarely, if ever, the same, and surprisingly, neither balance will reflect the correct balance of cash. There are two things that cause differences in the two balances. First, There can be timing differences in when the bank records a transaction and when the company records a transaction. There are several examples of such time lags. First, deposits in transit are deposits recorded in the company's books that haven't cleared the bank yet. So they will be reflected in the book balance but not the bank balance. Second, outstanding checks are checks recorded in the company's books that haven't cleared the bank yet. They are similar to deposits in transit as they will be reflected in the book balance but not the bank balance. Lastly, bank memoranda are adjustments made by the bank that the company doesn't know about until they receive the bank statement for the period, as discussed previously. These items will be reflected in the bank balance but not the book balance. The second cause of differences in the book and bank balances is errors, either by the bank or by the company. Because of the differences indicated here, we must prepare what's called a bank reconciliation to account for the differences. Now, let's talk about how these differences will impact the bank reconciliation. Deposits in transit are reflected in the book balance but not the bank balance, so we need to add them to the bank balance. Outstanding checks are also reflected in the book balance but not the bank balance, so we need to subtract them from the bank balance. Credit memos are reflected in the bank balance but not the book balance, so we need to add them to the book balance. Debit memos are also reflected in the bank balance but not the book balance, so we need to subtract them from the book balance. If an error is made by the company, meaning the book balance is incorrect, we need to adjust the book balance. If an error is made by the bank, meaning the bank balance is incorrect, we need to adjust the bank balance and also call the bank to ask them to correct the error. Here is a summary of the adjustments made to the balance per bank and the balance per books. We would add deposits in transit, subtract outstanding checks, and add or subtract bank errors to calculate the corrected bank balance. We would add notes collected by the bank, subtract NSF checks and bank charges, and add or subtract errors made by the company to calculate the corrected book balance. The adjusted bank balance and the adjusted book balance should match because they both reflect the correct balance at the end of the period. Once the reconciliation is prepared, any adjustments made to the book balance must be journalized. These adjustments would include any bank memoranda and errors made by the company. If we do not make these entries, then the cash account balance will be incorrect. This completes part 1 of the Chapter 7 lecture series on bank reconciliations. Have a great day.